Warren Buffett said this book changed his life. But what lesson inside makes it so powerful? The power of this book is not one secret trick, but a system of ideas that build smart investors step by step. Let's break this book into 15 simple parts and see how each lesson protects your money and your mindset. Part 1. What investing really means. Introduction plus Chapter 1. Investment versus speculation. This part explains the most important idea in the whole book: the difference between investing and speculation. Investing means putting money into something after careful thinking. The goal is long-term growth and safety. Speculation means guessing what prices will do in the short term. It is risky and often driven by emotions like fear and excitement. Benjamin Graham says that many people think they are investors, but they act like speculators. They buy because prices are going up or because others are buying. This is dangerous. A real investor uses facts, not feelings. A real investor asks simple questions. Is this company strong? Is the price reasonable? Is my money protected if things go wrong? The introduction also explains what the book wants to teach. It does not promise quick profits. Instead, it teaches how to avoid big mistakes. Graham believes avoiding losses is more important than chasing gains. Over time, steady and careful decisions lead to good results. This part also talks about behavior. Even smart people lose money when they follow the crowd. The market often makes people feel greedy or scared. Graham warns readers not to let the market control their actions. The investor should control the market, not the other way around. In short, Part 1 sets the rules. Investing is about discipline, patience, and safety. Speculation is about guessing and hoping. If readers understand this difference, they will already be ahead of most people in the market. Part 2. Inflation and Market History. Chapter 2. The Investor and Inflation, plus Chapter 3. A Century of Stock Market History. This part teaches investors to think long-term and learn from history. First, it explains inflation. Inflation means that money slowly loses its buying power. For example, something that costs $10 today may cost $15 in the future. If investors only save cash, their money may lose value over time. Graham explains that investing can help protect against inflation, but only if done carefully. Not all investments are safe. Some assets protect value better than others. The key is balance and understanding risk. Next, Graham looks at over 100 years of stock market history. The market has gone through wars, crashes, booms, and recoveries. Prices have risen and fallen many times. The important lesson is that markets move in cycles. When prices rise very fast, risk usually increases. When prices fall and people are afraid, good opportunities often appear. This history shows that people often repeat the same mistakes. They buy when prices are high and sell when prices are low. Graham wants investors to learn from the past so they do not panic or get too excited. The main message of Part 2 is simple. Do not focus only on today. Inflation and history both show why patience matters. Investors who understand long-term trends and stay calm during market changes have a much better chance of success. Part 3. The Defensive Investor. Big Picture. Chapter 4. General Portfolio Policy. The Defensive Investor. This part introduces the defensive investor, which Graham says fits most people. A defensive investor wants safety, stability, and reasonable growth. This investor does not want to spend a lot of time studying stocks or watching the market every day. Graham explains that defensive investors should spread their money across different assets, usually stocks and bonds. This is called diversification. Diversification lowers risk because not everything moves in the same direction at the same time. If one investment does poorly, others may do better. Another key idea is having clear rules. Defensive investors should decide their plan in advance and stick to it. They should not change their plan just because the market is noisy. Emotional decisions often lead to losses. Graham also warns defensive investors not to try to beat the market. Trying to be smarter than everyone else often leads to mistakes. Instead, the goal is to get fair results with low risk. This part teaches that investing does not have to be exciting to be successful. Calm, boring decisions often work best. For beginners and long-term savers, this approach is both practical and powerful. Part 4. Defensive Investors and Stocks. Chapter 5. The Defensive Investor and Common Stocks. In this part, Graham explains how defensive investors should choose stocks. The goal is not to find the fastest growing or most popular company. The goal is safety and reliability. Graham suggests buying stocks of large, well-known companies with a long history of profits. These companies should be financially strong and able to survive hard times. Paying regular dividends is also a good sign, because it shows the company earns real money. Defensive investors should avoid small, new, or fashionable companies. These may look exciting, but they often carry high risk. Popular stocks are often overpriced because too many people want them. When expectations are too high, even small problems can cause big losses. Another important idea is price. Even a good company can be a bad investment if the price is too high. Defensive investors should buy stocks at reasonable prices, not during times of extreme excitement. Graham emphasizes rules again. Using clear rules helps investors avoid emotional decisions. Instead of guessing, defensive investors follow simple standards for quality and value. This part shows that stock investing does not need to be complicated. By choosing strong companies, paying fair prices, and staying disciplined, defensive investors can build wealth while avoiding serious mistakes. Part 5. Enterprising Investors. What to avoid. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative approach. This part explains that before an enterprising investor learns what to buy, they must first learn what to avoid. An enterprising investor is someone who is willing to spend more time studying investments and hopes to earn better results than average. However, extra effort does not mean taking careless risks. Benjamin Graham warns that many investors lose money not because they lack intelligence, but because they make avoidable mistakes. These mistakes include buying low-quality companies, following popular trends, trusting rumors, or buying stocks only because prices are rising. Graham clearly says that excitement is not a strategy. He also warns against buying companies with weak finances, unstable earnings, or unclear business models. If a company cannot show steady profits over time, it may be dangerous, even if it looks cheap. Another major danger is buying into industries that are fashionable but poorly understood. When too many people chase the same idea, prices often become too high. Graham emphasizes that enterprising investors should not act like gamblers. They must avoid emotional decisions driven by fear or greed. Discipline is critical. A good investor knows when to say no and wait. The key lesson of this part is simple. Protect your money first. Avoiding bad investments is just as important as finding good ones. If investors remove the biggest risks from their decisions, they already improve their chances of success. In investing, what you avoid can matter more than what you choose. Part 6. Enterprising Investors. What to do. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. After explaining what to avoid, Graham now explains what enterprising investors should do. Enterprising investors are allowed to seek better opportunities, but they must do so carefully and logically. The goal is not fast profits, but smart buying at good prices. Graham introduces the idea of finding undervalued stocks. These are companies whose stock prices are lower than their true business value. This can happen when investors are overly negative, when a company is boring, or when temporary problems scare people away. Enterprising investors look for value where others are not paying attention. However, this approach requires work. Investors must study company financial statements, earnings history, and overall stability. Guessing is not enough. Graham strongly warns against relying on predictions about the future. Instead, decisions should be based on facts that already exist. Another important idea in this part is margin of safety. Enterprising investors should buy only when the price is clearly lower than the company's value. This creates protection against mistakes and unexpected problems. Graham also explains that enterprising investing is not for everyone. It requires patience, emotional control, and discipline. If an investor cannot follow rules or stay calm, this approach may fail. In short, this part teaches that enterprising investors can earn better results, but only by working harder, thinking carefully, and always protecting themselves from risk. Skill matters, but discipline matters even more. Part 7. Understanding market ups and downs. Chapter 8. The Investor and Market Fluctuations. This part teaches one of the most famous lessons in the book: how to deal with market fluctuations. Prices go up and down every day, and many investors let these movements control their emotions. Graham explains why this is dangerous. He introduces the idea of Mr. Market. Mr. Market is emotional. Some days he is happy and offers very high prices. Other days he is sad and offers very low prices. The smart investor does not follow Mr. Market's mood. Instead, the investor decides when to act and when to ignore him. Graham explains that market fluctuations are not a problem. They are an opportunity. When prices fall far below real value, investors may find good deals. When prices rise too high, investors should be careful or even sell. The biggest mistake investors make is reacting emotionally. Fear causes people to sell at low prices. Greed causes people to buy at high prices. Graham teaches investors to stay calm and focus on value, not daily price changes. He also reminds readers that owning a stock means owning part of a business. If the business is strong, short-term price drops should not cause panic. The key message is clear. The market is there to serve you, not to guide you. Investors who understand this lesson gain a strong advantage and avoid many common mistakes. Part 8. Funds and Financial Advice. Chapter 9. Investing in Investment Funds, Plus. Chapter 10. The Investor and His Advisors. This part discusses mutual funds and financial advisors, two common ways people invest. Graham explains both the benefits and the dangers. First, he talks about investment funds. Funds allow investors to spread risk easily, which is helpful for beginners. However, Graham warns that many funds do not perform better than the market over time. High fees and frequent trading often reduce returns. A fund that looks successful in 1 year may fail in the next. Graham encourages investors to pay attention to costs, not promises. Fees may seem small, but over many years they can take away a large part of returns. Next, Graham discusses financial advisors. Advisors can provide help, but investors should not blindly trust them. Some advisors are honest and skilled, while others may be careless or biased. Investors must stay involved and ask questions. Graham's key message is responsibility. Even when using funds or advisors, the investor must understand what is happening with their money. No one will care about your money more than you do. This part teaches that tools and experts can help, but they are not magic solutions. Knowledge, awareness, and caution are still required. A smart investor stays informed, keeps costs low, and never gives up control completely. Part 9. Simple Security Analysis for Everyday Investors. Chapter 11. Security Analysis for the Lay Investor. General Approach. In this part, Benjamin Graham explains how ordinary investors can analyze stocks without using difficult math or complex theories. He believes investing should be based on common sense and clear facts, not predictions or guesses about the future. Graham teaches that the first step is to understand the business itself. Investors should ask simple questions. What does the company do? Has it been making money for many years? Is it financially strong? A company with steady earnings and a solid balance sheet is usually safer than one with unstable results. Another key idea is focusing on past performance, not exciting stories. Graham warns that many investors get distracted by promises of future growth. These promises often sound good, but are uncertain. What matters more is what the company has already proven it can do. Graham also explains that investors do not need to be experts. They do not need to predict market trends or economic changes. Instead, they should use basic tools, such as looking at earnings records, debt levels, and dividend history. These facts help investors judge whether a company is strong or weak. The main lesson of this part is that simple analysis is powerful. Investors who carefully study a company's financial health can avoid many mistakes. By staying focused on real value and ignoring noise, everyday investors can make smart decisions without stress or confusion. Part 10. Earnings, Numbers, and Hidden Dangers. Chapter 12. Things to consider about per-share earnings. This part warns investors about trusting earnings numbers too easily. Many people believe that higher earnings always mean a better company. Graham explains why this thinking can be dangerous. First, he points out that earnings can be misleading. Companies can change how they report profits. They may include one-time gains or remove losses to make results look better. As a result, a single year of strong earnings does not always reflect the true health of the business. Graham encourages investors to look at long-term earnings, not just 1 or 2 years. A strong company should show steady profits over many years. Consistency is more important than sudden growth. If earnings jump up and down, the business may be risky. He also explains that per-share earnings can change because of stock splits, buybacks, or accounting choices. These changes do not always mean the company is actually doing better. Investors must understand where the numbers come from. Another key lesson is that numbers should be questioned, not accepted blindly. Graham believes investors should always ask, are these earnings real? Are they repeatable? Are they supported by strong business results? This part teaches investors to slow down and think carefully. By understanding earnings clearly, investors can avoid being fooled by attractive but weak financial reports. Part 11. Learning from company comparisons. Chapter 13. A comparison of 4 listed companies. Chapter 18. A comparison of 8 pairs of companies. In this part, Graham uses real company comparisons to teach an important lesson. A good company does not always make a good investment. Price matters just as much as quality. Graham compares companies with different reputations, earnings, and stock prices. Some companies look exciting and popular, but their stock prices are very high. Others look boring or slow, but their prices are low. Graham shows that investors often overpay for popular companies and ignore undervalued ones. The key idea is the difference between price and value. Value is what a company is truly worth, based on its business and earnings. Price is what the market asks today. When price is much higher than value, risk increases. When price is lower than value, opportunity may exist. These examples also show how emotions affect the market. Investors often chase success and avoid trouble, even when the facts suggest the opposite. Graham teaches readers to think independently and not follow the crowd. By studying these comparisons, investors learn how to evaluate choices calmly. This part helps readers practice real investment thinking and understand why patience and logic are so important. Part 12. Clear rules for choosing stocks. Chapter 14. Stock selection for the defensive investor plus. Chapter 15. Stock selection for the enterprising investor. This part explains how different investors should choose stocks using clear rules. Graham separates investors into 2 types: defensive and enterprising. Each type uses a different approach, but both must stay disciplined. For defensive investors, the rules focus on safety. They should buy large, well-established companies with long records of earnings and dividends. They should avoid risky businesses and overpaying for growth. The goal is steady performance, not excitement. Enterprising investors are allowed to dig deeper. They can look for undervalued companies or special situations. However, they must still follow rules. Enterprising investing requires careful study, patience, and emotional control. Without discipline, extra effort can lead to bigger mistakes. Graham stresses that no method works without consistency. Changing strategies based on emotions often leads to losses. Investors must choose the style that fits their time, skills, and personality. The main lesson of this part is that successful investing is about following rules, not chasing trends. Whether defensive or enterprising, investors who stay rational and focused have a much better chance of long-term success. Part 13. Special and Complex Securities. Chapter 16. Convertible Issues and Warrants. In this part, Benjamin Graham explains special types of investments, such as convertible bonds and warrants. These investments are more complex than regular stocks and bonds, so Graham believes investors should be very careful with them. A convertible bond is a bond that can later be changed into stock. At first, it acts like a bond and pays interest. Later, it may be converted into shares if the stock price rises. A warrant gives the investor the right to buy stock at a set price in the future. Both sound attractive, but they can be risky if not understood well. Graham warns that complexity often hides danger. Many investors buy these securities because they sound exciting or modern, not because they fully understand them. When investors do not understand what they own, they cannot judge risk correctly. He also explains that these special securities often become popular during strong markets. When prices are rising, people believe these tools will make them rich faster. However, when markets fall, the same securities can lose value very quickly. Graham's advice is simple and clear. Do not invest in what you do not understand. For most investors, especially beginners and defensive investors, simple stocks and bonds are enough. Special securities are not needed to succeed. This part teaches an important habit. A smart investor does not chase complexity. Instead, they choose investments they can clearly explain and understand. Simplicity helps protect money and reduces mistakes. Part 14. Lessons from Real Investment Failures. Chapter 17. 4 extremely instructive case histories, plus appendixes with case material. This part uses real-life examples of companies that failed or caused large losses for investors. Graham believes these stories are some of the most valuable lessons in the book. Success stories are interesting, but failure stories teach stronger warnings. The cases show companies that once looked strong and safe. They had good reputations, and many investors trusted them. Over time, problems appeared, such as weak finances, poor management, or risky decisions. When trouble came, investors who did not see the warning signs lost a lot of money. Graham explains that many losses happen because investors ignore danger signs. These signs include too much debt, falling earnings, or management that hides problems. Investors often refuse to accept bad news and hope things will improve. This delay can be very costly. Another key lesson is overconfidence. Some investors believe famous companies cannot fail. Graham shows that no company is perfect. Even large and well-known businesses can make serious mistakes. This part encourages investors to stay humble and cautious. It teaches that protecting money is more important than chasing high returns. By studying mistakes made by others, investors can avoid repeating them. The main message is clear: learn from failure. Careful investors watch for warning signs and act early. This habit can save money and prevent emotional decisions. Part 15. The core idea: margin of safety. Chapter 19. Shareholders and managements. Plus, Chapter 20. Margin of safety, plus preface, postscript, and commentary. This final part brings together the most important ideas of the entire book. The key concept is the margin of safety. Margin of safety means buying an investment at a price much lower than its true value. This gap protects investors from mistakes, bad luck, and unexpected events. Graham explains that no analysis is perfect. Even careful investors can be wrong. The margin of safety helps reduce the damage when errors happen. It is like wearing a seatbelt. You hope you do not need it, but it protects you if something goes wrong. This part also talks about the relationship between shareholders and management. Investors should pay attention to how companies treat shareholders, especially with dividends and honesty. Good management acts responsibly and thinks long-term. The preface by Warren Buffett supports Graham's ideas and shows how powerful they are in real life. Buffett explains that he followed these principles and achieved long-term success. The final message of the book is calm and practical. Investing is not about being smarter than others. It is about being disciplined, patient, and careful. Investors who focus on value, control emotions, and always demand a margin of safety give themselves the best chance to succeed over time. Now that we've gone through the key ideas, let me share my personal reflections. What truly spoke to me and how it connects to real life. The Intelligent Investor by Benjamin Graham is not a book about getting rich quickly. Instead, it teaches readers how to think clearly, stay calm, and make smart decisions when investing. What impressed me most is that the book focuses more on behavior than on numbers. Graham believes that emotions, not a lack of knowledge, cause most investment mistakes. One of the most important lessons is the difference between investing and speculation. Graham explains that investing is based on careful thinking, safety, and long-term results. Speculation is based on guessing and hoping prices will rise. Many people believe they are investing, but they are actually speculating. This idea made me realize how easy it is to follow the crowd without understanding real value. Another strong message in the book is how to deal with market ups and downs. Graham uses the idea of Mr. Market to explain that the market is emotional. Prices often move because of fear or excitement, not because of real business changes. Instead of reacting emotionally, investors should use market changes as opportunities. This teaches patience and self-control, which are useful not only in investing, but also in life. The book also explains that most people should be defensive investors. This means focusing on safety, diversification, and steady growth instead of trying to beat the market. Graham shows that simple rules, followed consistently, often work better than complex strategies. This idea feels realistic and practical for ordinary people. The concept that ties everything together is the margin of safety. Graham believes investors should always buy at prices well below real value. This protects them from mistakes and unexpected problems. No one can predict the future perfectly, so safety is more important than being right. Overall, The Intelligent Investor changed the way I think about investing. It teaches that success comes from discipline, patience, and clear thinking. The lessons are simple, but they are not easy to follow. This book is not just about money. It is about learning how to make better decisions over the long term. If you remember nothing else from this book, remember these 5 core ideas. 1. Investing versus speculation. Investing focuses on long-term value and safety. Speculation is short-term guessing driven by emotions. 2. Control your emotions. Fear and greed cause most mistakes. Smart investors stay calm and think independently. 3. The market is a tool, not a guide. Market prices change because of emotions. Investors should use these changes, not follow them. 4. Most people should invest defensively. Simple rules, diversification, and patience work better than trying to be clever. 5. Margin of safety is the key. Always buy with a gap between price and value. This protects you when things go wrong. These ideas have guided the world's greatest investors, and they can guide you too. Like this video if you want more insights, and subscribe for more brilliant thoughts.